Hello everyone, this is Jennifer. In this video, we're going to look into the revaluation of assets and liabilities problems in the accounts of groups of companies. So, what do you mean by revaluation is if at the time of acquisition of shares, the assets and liabilities of the subsidiary are revalued for determining the value of shares. So, the profit or loss on such revaluation is nothing but your capital profit or capital loss. So they have given the balance sheet, we have the equity and liabilities, and we have the assets. So the additional information that is given is how many shares have been acquired by Somya Limited. So Somya Limited acquired 800 shares of Sneha Limited. So the parent company is Somya, subsidiary company is Sneha. So the creditors of Sneha Limited includes 3000 due to Somya Limited, which is nothing but your intercompany owings. And on 31st 12 2015, building of Sneha Limited are found undervalued by 10,000 and the plant of same is found to be overvalued by 5,000. So the undervalued amount needs to be added to make it to the correct amount. The overvalued amount needs to be minused respectively from your capital profits. So the new values are to be incorporated. So the balance of profit and loss account of Sneha Limited is 18,000, represent the profit of the company earned during the year ended 31st 3 2015. So this is nothing but your, so it is earned during the year 31st 3 2015. So when was the company acquired? 2014. So these will come in your revenue profits. So we start with your calculation of your ratio. So the number of shares in Sneha Limited is 1 lakh, which is divided by 100 rupees per value share. So the total number of shares is 1000. Number of shares acquired by Somya Limited is 800 shares, and the number of shares acquired by the minority shareholders is 200. So the ratio is 800 is to 200, which is 4 is to 1. So the calculation of capital profits, capital reserve. So in your question, if you see, there is capital reserve was 60,000 of Sneha Limited and the profit and loss account is 80,000. So there is no general reserve. So capital reserve is 60,000. So you add your profit and loss account for 3 months. Okay, so profit and loss account for 3 months, that is for 80,000 into 3 by 12. Why 3 by 12 is in the month of uh, July the company was acquired, but the balance sheet is prepared from April 2014 to March 2015. So April, May, June, so 3 months it comes under your capital profit. So that is before your acquisition. So after July it becomes your revenue profit. So 3 into 3 by 12, which is for 3 months. So you get 4,500 as your profit and loss account for 3 months. So you add your increase in the value of the building. Since it is undervalued, so you need to increase it, so you will add it, which is 10,000, and decrease in the value of the profits. So decrease in the value of the profit, which is 5,000. So if you do it, you get your capital profit to be 69,500. So the share of Somya Limited is 69,500 into 4 by 5. So which you get 55,600, and the share of minority shareholders is 69,500 into 1 by 5. So you get 69,500 into 4 by 5, which is 55,600, and 69,500 to 1 by 5, which is 13,900. So the calculation of revenue profits, profit and loss account for 9 months. So for 3 months we are considering it as capital profit. So the next 9 months will become your revenue profit. So 18,000 into 9 by 12, 13,500. So the share of Somya Limited is 13,500 into 4 by 5, which is 10,800, and share of minority shareholders is 13,500 to 1 by 5, which is 2,700. So next is calculation of non-controlling interest, the face value of shares held by the minority shareholders. So they basically have how many shares? 200 shares into 100 rupees per share. So it is 20,000. So add your share of capital profits, which is 13,900, which we got it from our capital profits, 13,900. From revenue profits we got 12,700. So your non-controlling interest is 36,600. So calculation of goodwill or capital reserve. So cost of shares held by Somya Limited. So if you see in the beginning, in your balance sheet they would have given 800 shares in Sneha Limited, 1,70,000. So cost of shares held by Somya Limited is 1,70,000 less face value of 800 shares. They will not buy in the normal face value of shares itself, they will buy at extra or lesser. So 800 into 100, 80,000. Share of your capital profit is 55,600. So you have a goodwill of 34,400. So you start with your consolidated balance sheet as on 31st March 2015. So equity shareholders funds. So under that, equity share capital, so equity share capital of 100 each, which is 2,50,000. And moving on to your reserves and surplus, under that profit and loss account, Somya Limited is 28,600, Sneha Limited is 10,800. So you get your total of 39,400. Non-controlling interest is 36,600. So under non-current liabilities, other long-term liabilities, loan from bank, Somya Limited is 50,000. So current liabilities, accounts payable, bills payable, Somya Limited is 23,550, Sneha is 4,700. Total you get 28,250 minus your intercompany owings, which they have given in the adjustment, which is 1,500. So you get 26,750. So you have your intercompany owings, right? Where they have given in your asset, including 1,500 from Sneha Limited. That is nothing but your intercompany owings. Next, sundry creditors, Somya Limited and does not have anything. Sneha Limited is 4,000. So your intercompany owings is 3,000. Balance is 1,000. So you get your balance sheet to be tallied by 5,23,750. So moving on to your asset side, we have your non-current asset. Under that you have your fixed assets. Under that tangible assets, buildings. So Somya Limited is 75,000, Sneha Limited is 90,000. So if you see, buildings have an appreciation of 10,000. So which means to tell it was undervalued, right? So you add the appreciation, which is 1,75,000. And Somya plant, moving on to plant, Somya Limited is 1,20,000, Sneha Limited is 54,700. Less your depreciation, it was overvalued, so you minus your depreciation, which is 5,000, 1,69,700. Intangible assets, goodwill, we have 34,400. So current assets, inventories, Somya Limited is 70,000, Sneha Limited is 18,000, so 88,000. Accounts receivable, sundry debtors, so Somya Limited is 21,000, Sneha Limited is 20,000. Minus the intercompany owings 3,000, you get 38,000. Bills receivable, Somya is 7,700, less your intercompany owings 1,500, you get your balance to be 6,200. Cash and cash equivalent, Somya Limited is 8,450, Sneha Limited is 4,000, so you get your balance to be 12,450. So moving on to your previous sums, there is one thing that we want to clarify in your previous sums. So if you get back to the 15th and the 16th illustration, if I'm not wrong, 14th, So this is the sum wherein the illustration, there's an illustration 12 wherein there is goodwill and there is also capital reserve. So goodwill, there are goodwill of two companies, okay, which is H limited 1,50,000 and H limited 35,000, and we have a capital reserve from our calculation of fifth step, so which is 17,000. So in this case you minus the capital reserve from your intangible asset, and you do not consider in your reserves and surplus, only general reserve is considered. If you see the next problem, which is your 14th problem, I'm sorry, 13th problem, if you see in this, there is again goodwill and there is again capital reserve 8,500. In this, the goodwill is lesser than the capital reserve. So in reserves and surplus, you will take your capital reserve and you will minus your goodwill of 5,000, which is from your subsidiary company. And in your asset side, you will not take your goodwill. So moving on to our next chapter, which is disclosure of standards. So disclosure standards, under that, what do you mean by related party disclosure? So basically, what does related party means? A related party is a person or entity that is related to the entity that is preparing its financial statement. So it can be a close member, so or it can be someone who has a control or an influence on the over the reporting entity, or an entity which is having a joint venture with another entity, or both entities or a joint venture for the third party. So all these are related party transaction wherein it affects your financial statements. So how do you disclose such related party transaction is, so this is the standard which talks about related party disclosure, which is IND AS 25. So IND AS 24 is to ensure that an entity's financial statement contains the disclosures about transactions and outstanding balances with the entity's related parties. So the basically it shows various categories or classes of entities and the people who are considered to be related parties, and how the transaction are need to be disclosed, including the compensation of the key management personnel. So the standard shall be applied basically in identifying the related party relationships and transactions. The second one is showing their outstanding balances, commitments, and etc. And the third one is identifying when the disclosure should be made or not, whether it affects your financial statement or not. And the last one is determining the disclosures to be made. If it is made, what is the amount needs to be disclosed. So there are certain conditions wherein the person cannot be related parties. So, the example could be two entities simply since they have a same director or key manager, they cannot be related parties. Or two ventures who share joint control over a joint venture, they cannot be a related parties. Or providers of funds, trade unions, etc. departments, they cannot be a related party. Or a single customer, supplier, franchisor, distributor, etc. cannot be a related party, or general agent cannot be a related parties. So with whom an entity transacts a significant volume of business merely by virtue of the resulting economic dependency. So the disclosures, the relationship between parents and subsidiaries. So regardless of whether there are been transaction between the parent and the subsidiary, an entity must disclose the name of its parent, and if different, the ultimate controlling party. If neither the entity's parent nor the ultimate controlling party produces financial statements available for the public use, so the name of the next most senior parent that does so must also be disclosed. So what all needs to be disclosed here is, So whether the transaction between the parent and the subsidiary company, an entity must always disclose the name of the parent company or the ultimate controlling party. So what all management compensation are we talking about is the short-term employee benefits, or the post employee benefits, the other long-term benefits like your PF, pensions, the termination benefits, the share based payment benefits if there are shares provided to the key manager persons on behalf of the company instead of giving them cash or salary, so that also needs to be mentioned. So what needs to be disclosed is the amount of the transaction, the amount of outstanding balances including the terms and conditions and guarantees, and also the provision for doubtful debts related to the amount of outstanding balances and the expenses recognized during the period. So the next topic that we're going to look into is the earnings per share. So Ind AS 33 talks about earnings per share. So it sets out how to calculate both the basic earnings per share and the diluted EPS. So what do you mean by basic earning per share? So the basic EPS or the diluted EPS both are basically used in order to measure the profitability of a company. The basic EPS is calculated taking into account the outstanding equity shares in companies, whereas the diluted EPS includes convertible shares such as employee stock option, warrants, debentures, and its calculation. So, so this Ind AS 33 applies to entities whose securities are publicly traded and that are in the process of issuing securities to the public. So how it is basically disclosed is if EPS is present, the following disclosures are required. The amounts used as the numerators in calculating the basic and the diluted EPS, and the weighted average number of the ordinary shares used as the denominator, and the instruments that could potentially dilute basic EPS in the future. So that could basically get convert into convertible shares, and also as a description of those ordinary share transaction or potential ordinary share transaction that occur after the balance sheet date but would significantly or impact and that would have changed significantly the number of ordinary shares or potential ordinary shares outstanding at the end of the period if those transactions had occurred before the end of the reporting period. So such things will be disclosed. So next, moving on to your interim financial reporting. So interim financial reporting is basically Ind AS 34. So it prescribes the minimum content of an interim financial report and to prescribe the principles for recognizing and measuring incomplete or condensed financial statements for an interim period. So it is basically a complete or a condensed set of financial statement for a period that is shorter than your financial year. So what is the scope of this interim financial reporting is it does not mandate which entity should be publish interim financial reports. So second one is each financial report, annual or interim, is evaluated on its own for conformity to Ind AS. Okay, and the third one is if any entity's interim financial report is described as compiling with NDS, it must compile with all the require. If it compiles with NDS, then it should take over all the requirements of the standard. So how does it basically measures is the measurement for interim reporting purpose should be made on a year to date basis so that the frequency of the entity's reporting does not affect the measurement of its financial reports. So year to what date it is making its financial reports. So materiality in deciding how to recognize, measure, classify or disclose an item for reporting purpose. Materiality is to be accessed in relation to the interim prior financial report, not forecasting the annual data. So only for during that particular period what has happened, we're just looking into the interim period's financial data. So the disclosure in your annual financial statement, if an estimate of an amount reported in interim period is changed significantly during the financial interim period in the financial year, but a separate financial report is not published for that period, the nature and amount of that change must be disclosed in the notes. So the anything that happens or any changes that happens should be disclosed in the notes to the annual financial statements. Thank you everyone.